Let's get right into this explainer, the day the world ran out of cash. It's so easy to just assume the global financial system is this perfectly stable, well-oiled machine. But we're going to look at a terrifying 48-hour period where that machine came dangerously close to collapsing. And the crazy part, it almost happened in total silence.
48 hours. It really all came down to a critical 48-hour window. For those 2 days, the hidden plumbing we all rely on, specifically the short-term overnight lending and repo markets, just evaporated. Poof, gone. Massive global banks literally stopped trusting each other. Trillions of dollars tied up in collateral were suddenly hanging in the balance, and honestly, almost no one in the general public even knew it was happening.
The global financial system almost froze. I want you to really put yourself in this scenario for a second. Imagine waking up tomorrow, you check your banking app, and it's just endlessly loading, just stuck. You walk down to the corner to get some cash, and the ATM says temporarily unavailable. You try to buy a coffee, declined, again and again. That immediate sinking panic in your stomach, that is exactly what started happening globally, right behind the scenes to the most powerful financial institutions on Earth.
The 48-hour silent freeze. So how exactly did this happen? Well, we're going to explore how banks quietly and suddenly stopped trusting each other. It caused the literal lifeblood of the global economy to just instantly stop moving. Because look, in the world of high finance, trust isn't just an important thing. It's the absolutely crucial thing. It's the only thing. When liquidity dries up and counterparty risk spikes, panic spreads faster than a virus behind closed doors.
What did they tell the public? That's the real question, right? With panic spreading like wildfire among economists and bankers and private, a massive gap opened up between the inside reality and the outside messaging. As the very foundation of global finance was cracking, what was the message being broadcasted to the average citizen to keep them from yanking all their money out of the bank? Well, the official story was incredibly reassuring. They spun it as just a temporary liquidity shortage, a minor hiccup, really. They promised the core institutions were fundamentally strong. It sounded completely safe and controlled. But actually, scratch that. Beneath that comforting illusion was the truth, a ticking time bomb. Systemic, global liquidity problems simply do not appear out of thin air.
The system's ticking time bomb. The absolutely crucial thing to understand here is that the system didn't just break suddenly out of the blue. No way. It was already breaking. It had been fracturing slowly, quietly, and deliberately for years. And it was all because of a massive, heavily guarded secret at the core of modern banking. The global financial system was essentially sitting right on top of this time bomb, deeply tied to how capital was actually being created and moved around.
And at the heart of this was leverage, lending money based on money that was borrowed from other borrowed money. Instead of a standard multiplier, institutions were operating with extreme fragility. They were stacking rehypothecated assets, basically using borrowed money to secure more borrowed money. It was a staggering tower of debt. This meant there was far, far less actual, unencumbered cash in the system than anyone wanted to admit. The entire structure only stood up as long as everyone kept believing the collateral was sound.
Which brings us to the interbank market. This is the fragile center of the system, the core where banks lend money to each other daily. When that vital mechanism of banks lending to each other to meet overnight reserve requirements seizes up, the whole machine halts. If one massive institution looks at another's balance sheet and thinks, wait a minute, what if their collateral is toxic and they can't pay me back tomorrow? The lending stops, instantly.
When the markets froze. That is precisely when it happened. Counterparty doubt finally entered the system, and because everything was so deeply interwoven, it spread like wildfire. Major institutions suddenly clammed up and hoarded cash. And this wasn't some unavoidable accident or an act of nature. It was the direct result of years of reckless lending, totally ignored warning signs, and the kind of blind confidence you really only see right before a disaster. It was literally like watching someone juggle flaming knives while smiling and saying, "Relax, I've done this before."
This disaster maps out into a devastating four-step spiral: greed, risk, denial, and collapse. First, the pursuit of outsized profits drove rampant greed. That greed systematically normalized unchecked, dangerous risk across trading desks. When the cracks finally started showing, there was quiet denial by both the executives and the regulators who were supposed to be stress testing the whole thing. Ultimately, that combination triggered a rapid, systemic collapse where short-term funding simply vanished. Small fractures became massive, gaping canyons overnight.
If money could scream, this is the moment it would have lost its voice. That quote perfectly captures the mood inside those trading rooms.
For those 48 hours, markets didn't crash loudly with traders yelling on a floor. They froze quietly. Banks held on to whatever cash they had like it was oxygen. No one wanted to lend. No one wanted to risk exposure. It created this silent panic where no buyers or sellers could escape. Just total, suffocating uncertainty.
The secret artificial rescue. So the crucial point here is that the system didn't magically save itself. As the global economy stared over the edge of the abyss, it didn't naturally correct. In fact, many experts argue something highly controversial, that the system was actually allowed to break just enough to create the ultimate panic. And why? To justify a massive, unprecedented, and largely hidden intervention from the central banks.
Let's look at this artificial rescue. Behind closed doors, governments and central banks stepped in aggressively. They injected massive liquidity, they guaranteed failing loans and toxic assets so institutions wouldn't go under, effectively stabilizing the collapsing infrastructure. In simple terms, they essentially printed artificial trust back into the system to stop the panic. And on the surface, it worked. The panic slowed, credit markets resumed, and the world seemingly moved on.
The true cost of trust. We absolutely have to talk about the true cost of that trust. Because sure, they may have stopped the immediate 48-hour freeze, but they didn't fix the underlying broken structure. They simply postponed the consequences. By flooding the market with capital, more money entered the system than ever before in human history. Debt levels skyrocketed, and asset prices were artificially inflated just to keep the whole illusion going. The invisible impact. Here is exactly why this matters to you right now, today. Over time, that behind-the-scenes intervention directly shifted the burden onto us. That artificial rescue became a massive driver behind the higher cost of living we see today. It fueled inflation, created highly unstable, jittery markets, and rapidly accelerated severe financial inequality. People think the crisis ended after those 48 hours. It didn't. The cost was just quietly transferred to the rest of us.
Greed wins the short game, but destroys the long one. Ultimately, this entire event boils down to an uncomfortable truth about human nature. Finance isn't just about math, complex algorithms, or cold hard numbers. It is truly about fragile human trust. We almost lost everything because highly educated people got greedy, willfully ignored obvious risks, and arrogantly believed they were perfectly in control of the complex machine they built.
Which leaves us with this final, lingering question. What happens the next time trust disappears? The crisis didn't actually end. Those underlying behaviors and the massive leverage, they're still present in the shadows. The system just changed form. So I'm going to leave you to ponder this terrifying thought about the future of our financial system. If this is what happened during a 48-hour silent freeze, what happens the next time that fragile trust entirely disappears?